Hey guys, so I wanted to give you a little taste of, I guess, my take on the Royal Commission report that's just come out. The Royal Commission into misconduct in the banking, superannuation, and financial services industry, and the recommendations in regards to mortgage brokers, which are, as you can see them all behind me here. Anyway, let's just jumping back from that, something else I kind of want to tackle quickly. We saw bank shares jump up the day after the Royal Commission came out, so the Tuesday, massive gains. So not surprisingly, these gains then came back down to sort of their previous levels within a day or two. Now, my thoughts, out there you will see in the media and some brokers and whatnot saying that that was caused purely by the Royal Commission. My thoughts are different in that I think that there was probably a lot of short selling on the big four banks. Derivatives to be able to short sell on the big four banks are pretty easy to get, or the banks, the financial institutions generally. So I think there was a lot of traders who had pretty big short positions and were expecting at least a little bit of loss on them. Now, it would probably show that the report was slightly better for banks than was otherwise expected, but any kind of stability in that price or even a slight price increase after there was a likely decrease kind of factored in by the market, anyone who is short selling would probably want to get out of that pretty quickly, which can kind of catapult the price up therefore pretty quickly as well. So whilst I'd love to use that as kind of a marketing tool, I actually don't really agree. And we saw the price come back down to relatively similar levels relatively quickly. So yeah, I think if you kind of look a little bit further behind the veil or under the water, as it were, I think that's probably what was happening. Although there hasn't been a great deal of kind of extra regulations or upheaval in the banking industry from the report, but pointing to this share market, I think shows more maybe ignorance around the mechanics of the market, as opposed to this is definitive proof. Anyway, I mean, in everything that I'm saying today, I'm probably not going to win any mortgage broking friends. I will try to look at this fairly even-handedly, and I can't really help but look at any of you who know me or have worked with me. I tend to over-explain things and over-analyze, and part of that is I kind of very much look at this as, okay, industry as a whole, but the economy as a whole, is this making it better? What are the actual effects? What are the long-term effects? As opposed to what's the short-term pain on me? And there definitely will be short-term pain on me, but let's take that out of it when we're looking at it. You look in the news and you've got people on one side who are saying, hey, this is exactly what's needed, broker commissions need to be completely scrapped, yada, yada, yada. And they basically say things that aren't really in this. Like it's not as harsh as some people think. And then you've got other, I suppose a lot of brokers saying, hey, this has gone way too far. The industry is going to collapse. And I certainly don't agree with that either. Anyway, so let's go through the recommendations. So there are 5 specifically in relation to mortgage brokers, or as you can see, consumer lending, intermediated home lending. Recommendation 1.2, best interest duty. This is a no-brainer. The law should be amended to provide that when acting in connection with home lending, mortgage brokers must act in the best interest of the intending borrower. The obligation should be a civil penalty provision. I completely agree with this. The way this will change what we do, at the moment, we need to find a loan that is not unsuitable. So it's not even that we need to find someone a suitable loan, we need to find them a not unsuitable loan. So that's a very, very low bar. And it means that from a legislative point of view, it's pretty hard to prove that someone found an unsuitable loan, because if the loan is not suitable, then how did the person even get into it? And it's a little bit murky. Whereas this, much better. I actually really like this change, must act in the best interest of the intending borrower. So the broker is going to really need to know some background information about why this is in the best interest of the client. Think about the long term and the other things that the clients, like, they're going to be forced to, because if someone comes back and says, hey, you didn't act in the best interest of this client, the broker is going to need to prove that they did, and they're going to have file notes and actual reasons as to why it was in that person's best interest. So I think that's really, really good. A slightly increased kind of paperwork trail requirement, but nonetheless a really good one. Recommendation 1.3. Now, this is the one that most mortgage brokers really don't like, and most mortgage brokers think is going to destroy the industry or push heaps of mortgage brokers out. For me, I think there's a different one that's actually going to probably push more brokers out of the market than this one. Anyway, so this is essentially over a period of 2 to 3 years, a mortgage broker should not be receiving upfront commission or trail commission. And so the commissioner recommended that this be taken out over a period of 2 to 3 years, first trail commission and then upfront commission. And that the borrower, not the lender, should pay the mortgage broker a fee for acting in connection with home lending. So rather than the lender paying me commission, either upfront only or upfront and trail, it would be the borrower. Now, I don't think it doesn't go into it here, but further in the report it does explain that it would be good for this fee to then be able to be capitalised into the loan. So whilst it would be that person paying it essentially up front, they'd be able to put it into the loan. Now that brings other complications with it around loan to value ratios and that sort of thing being affected by it. If you don't understand what I'm saying there, definitely feel free to leave a comment, hit me up, whatever. Happy to chat about this all day, as you'll see by the length of this video. But other than that, there are quite a few countries, and Australia used to have only upfronts, and we didn't have trail. And what Commissioner Haynes said about it being essentially money, I don't think he used the term money for jam, but money for sitting on our bums or money for doing nothing, basically, is that the requirement of trail is just that. There is no requirement for a broker to do anything for it. So in essence, he is right. It was originally brought in from everything that I'm aware of, so that a broker wouldn't churn their clients. So they receive an upfront, can't get anything more from that client, so 12 months later or however long, they then refinance to another lender and get another chunky upfront. And so having a trail disincentivises that broker from moving them because they're already making money. So it sounds horrible. Like the finance industry, sometimes I kind of wonder why I'm even in it, but it does. I think it does kind of attract a sort of person that you probably don't aspire to be. That being said, I don't think everyone in the finance industry is like that, but I think it can attract a certain type of person. Let's leave it at that. Anyway, I don't think this is necessarily a bad thing. Certainly moving from upfront and trail to just upfront, there's ways to do it that really wouldn't be a problem. What a lot of brokers have now is they base their entire model and their business structure around receiving a trail income. And so that's where it makes it different and sort of difficult. If you receive a large amount of your income at the moment through trail income, then that could be quite difficult as well. So your trail might be paying for and offers and staff and that sort of thing that under the new system you might not have that sort of income and ability potentially to do that. So it would cause upheaval in the short term. I think really pretty much any model is workable, and I think for those brokers who do adapt to whatever the change is, that they'll probably actually do quite well out of this, to be honest. So that's recommendation 1.3, and part of it is, let's look at recommendation 1.4. Let's see if I can do that. All right, I'll still be looking at it this way, but anyway. So recommendation 1.4 is Treasury-led working group should be established to monitor and, if necessary, adjust the remuneration model referred to in recommendation 1.3. So what we haven't really heard is, like from maybe some of the broker side is, hey, this is the recommended model, but as things become tricky and probably not that workable, we want to make sure there's a working group to bring that in line or change that as need be. So I think that's obviously a really good thing. It hasn't really been spoken of that much, but having a working group to test and adjust, basically, really good idea. Now, the last part of that, and any fee that lenders should be required to charge to achieve a level playing field in response to market changes. So what I've heard from a lot of brokers, and I love brokers, or people in general, is, hey, we wouldn't go to you if we have to charge you a fee compared to going to the bank if we're getting exactly the same product and the same everything. And you go to a certain extent, depending on what you need. If you don't need an advice component, and mortgage brokers aren't financial advisors, so we're very limited in the advice that we can give. As great as my advice is, absolutely, I'd go to the bank. But part of the recommendation is that the bank would also have to charge to achieve a level playing field, so to maintain competition. Now, when you think about, and you go, well, why would a bank charge that? Like, a bank's just going to not charge it, or they're going to wrap it up in some kind of, they're going to give people a bonus of that back. That could happen. But when you think about it, that could happen now. So a bank pays me an upfront commission and a trail commission. Now, if a client or if someone went straight into a bank, they can get the exact same loan, and whether you go through broker channel or the bank channel, you'll be getting the same rates, as long as the bank manager or the broker know exactly essentially kind of how to get the best rates. A lot of the second tier lenders and the non-bank guys and the ones who aren't in the big four, they just tell you what it is, so it's a lot easier. But the big four kind of hide it, but brokers can get exactly the same rates as going directly to the bank. Now, if you go through a broker, the bank pays the broker. If you go straight to the bank doesn't pay you the brokerage for putting your loan together, do they? So at the moment, the bank could charge you a lower loan because they're paying out, because they don't have to pay a broker. So whilst people say, okay, well, under a fee-for-service model, a flat fee, the banks won't do it. Well, at the moment, they don't actually have to do it, but they essentially do. They just keep that extra fee. And I mean, obviously, why wouldn't they? If there's a fee-for-service model, in reality, they'd be more than happy to keep an extra fee. So I don't actually think that argument holds that much weight, because I don't think it will happen, because it doesn't happen now, and it could happen now. Anyway, what have we got next? So recommendation 1.5, mortgage brokers as financial advisors. I'm probably pretty neutral on this one. On the remuneration one, I'm probably pretty neutral as well. The working group thing is awesome. Best interest duty, awesome. 1.5, mortgage brokers as financial advisors. I'm neutral. I'm set up pretty well in that I've got an economics degree, majored in finance. I have a financial planning diploma. I'm pretty well set to be able to kind of get my qualifications up to where they need to be with that. I wouldn't actually be there right now because financial planning bar is very high, but it wouldn't take me much work, whereas a lot of other brokers, it would take a lot of work. So when a lot of brokers entered the industry, or still now, you can knock over the qualifications within a week. So I'm kind of neutral on whether we need to. A broker is broking a specific product. If they're offering advice, fantastic, you probably should use that person. But should we force a broker of a product to have such high standards from an advice perspective? As I said, I'm neutral. I'm not sure. If it happens, it will quite greatly benefit for me. And this is one that I was talking about before, in that I think this will knock more mortgage brokers out of the industry than changing the fee structure, to be honest. And the last one, 1.6, misconduct by mortgage brokers. So ACL, Australian credit licence holders should be bound by information sharing and reporting obligations in respect of mortgage brokers, similar to those referred to in recommendations 2.7 and 2.8 for financial advisors. I won't actually go into them. Take the same steps in response to detecting misconduct of a mortgage broker as those referred to in recommendation 2.9 for financial advisors. So it basically puts a greater onus on license holders who might have credit representatives under them, that if they see any misconduct by a broker, there is a higher bar or a lower bar for which they essentially have to report that to ASIC, essentially. And I think that one's really good as well. So there will be much less kind of trying to do things in-house and fix people in-house or sweep it under the rug or that sort of thing that might happen. And so I think that's actually quite a good one as well. So recommendation 2, best interest, awesome. 3, broker remuneration. I'm kind of neutral on that, to be honest, but I think it'll help me because I'm happy to go wherever we go. 4, establishment of working group. I think that's necessary with number 3, and it's not talked about that much. Recommendation 5, brokers as financial advisors. I'm neutral on that, but I mean that would be quite good for me as well. Recommendation 6, misconduct by mortgage brokers. That's really good as well. So that's my take on the recommended changes. We'll see which ones actually take effect and go from there. So anyway, any other questions you've got? I don't know exactly how long this is, but if you stayed until the end, well done. You're probably not like everyone else. But if you do have any questions, please let me know. Please ask them. I hope this was pretty informative, and I hope it was pretty kind of on a level keel, not crazy one way or the other, and has given you a bit of an idea into what all this hoo-ha is actually about. It's about these 5 recommendations and the ramifications of them, and I've kind of spilt them or my thoughts on them right there. Thanks, guys. Bye.